Welcome to the sixth episode of our Foundation series. Today, we are pulling back the curtain on the mechanics of the market. We are going to explore exactly who moves prices in the United States stock market, and more importantly, why knowing these players matters to every single investor. Whether you're just starting out or looking to sharpen your edge, understanding the cast of characters behind your screen is essential. It is not just about what you buy. It is about recognizing the forces that dictate the value of your assets. Let us get started by mapping out who is actually pulling the strings. Every single trade you place has two sides. When you purchase a share of Apple or an exchange-traded fund, someone else is selling it to you, and their motivations are rarely the same as yours. Understanding who these counterparties are, how much capital they control, and the specific rules they follow is not just Wall Street trivia. It is the key to understanding why prices suddenly gap down at 9:31 in the morning, why your order fills at an unexpected price, or why a stock can swing 20% on a day with no major news. We are going to map these players so you can see the market for what it truly is. To understand how these participants interact, look no further than May 6, 2010. At 2:42 in the afternoon, a single institutional program sold 75,000 E-mini S&P 500 futures contracts, worth about $4.1 billion. This triggered a massive cascade. High-frequency algorithms detected the pressure and began selling aggressively, which amplified the move. The Dow Jones Industrial Average plunged 998.5 points in roughly 5 minutes, erasing nearly $1 trillion in market value. By 3:07, most of the loss had recovered. This event is the definitive proof that the identity of the traders and their systems shapes prices far more than any earnings report. When we look at the ownership map, the dominance of large institutions becomes clear. These entities, including pension funds, mutual funds, hedge funds, and endowments, own approximately 80% of the shares outstanding in S&P 500 companies. They also account for 80% of the trading volume on the New York Stock Exchange. While 62% of American adults own stock, the retail slice of total equity value is much smaller. In fact, the top 1% of Americans by wealth hold 50% of all United States stock wealth, totaling roughly $23 trillion. This concentration proves that institutional flows, not retail sentiment, are the primary drivers of long-term price trends. Three asset managers stand above the rest: BlackRock, Vanguard, and State Street. Together, they control over 20% of total United States market capitalization and own roughly 25% of voting shares in corporate America. As of early 2024, BlackRock managed $10.5 trillion, Vanguard managed $9.3 trillion, and State Street managed $4.3 trillion. They are the largest shareholders in 88% of S&P 500 companies. Because they manage passive index funds, they rarely sell, making them permanent owners with massive proxy voting power. Interestingly, Vanguard is actually BlackRock's largest shareholder, holding a 9% stake in their rival. Mutual funds serve as the primary gateway for retail investors, holding $28.5 trillion in total net assets at the end of 2024. Equity funds specifically account for $15.5 trillion, which is 53% of that total. Households hold 88% of these assets. Index mutual funds have grown to $6.9 trillion, representing 32% of long-term mutual fund assets, up from 19% in 2010. When millions of 401k participants contribute every payday, those inflows are gathered by fund managers who deploy billions into the market systematically, regardless of whether stocks seem cheap or expensive at that moment. Pension funds are the silent giants of the market. Global pension assets hit a record $69.8 trillion by the end of 2024, with $63.1 trillion managed by professional providers. In the United States, these plans operate on liability-driven investment frameworks, meaning they must match future pension obligations with current returns. Their investment horizon is measured in decades, not quarters. When a pension fund decides to rebalance a $50 billion portfolio from equities to bonds, the shift happens over several weeks using algorithmic execution to minimize market impact. Even so, the sheer volume of these moves is enough to shift market prices significantly. Hedge funds are the active movers of the industry, managing between $4.1 and $4.5 trillion as of the end of 2024. 66 firms managing at least $10 billion each control $1.77 trillion, which is 39% of the total industry. Bridgewater Associates remains the largest manager, while Citadel LLC reported $445.96 billion in firm-wide assets as of June 2025. Unlike pension funds, hedge funds face quarterly redemption windows and high watermark performance pressure. Their trades are concentrated, leveraged, and fast. A single position change from a major hedge fund can move a mid-cap stock 10% in one day. Insurance companies held $9.6 trillion in cash and invested assets at the end of 2025, marking the largest annual increase in 4 years. Their allocation is intentionally conservative. Bonds make up 60.4% of the portfolio, while common stocks represent 13.1%, or $1.17 trillion. Mortgage loans account for 9.1%, and cash makes up 6.3%. Life insurers hold 64% of these assets, while property and casualty insurers hold 32%. Because regulators require capital reserves against equity holdings, insurers prefer to buy and hold large-cap dividend payers. Their flows are steady, predictable, and heavily focused on bonds. Sovereign wealth funds are state-owned investment vehicles that deploy capital from commodity exports or foreign reserves into United States equities. Norway's government pension fund Global holds massive stakes in most large-cap companies. Singapore's GIC and Temasek are also active tech investors. In the second quarter of 2024 alone, Temasek increased its holdings in tech giants by $3.3 billion, including Microsoft, Apple, Meta, Amazon, and Nvidia. Specifically, its Nvidia position grew 18-fold in share count, with the value tripling from $466 million to nearly $1.2 billion. These funds operate on generational time horizons, but can shift billions when geopolitical strategies change. Retail investors are becoming a rising force, now accounting for approximately 20.5% of daily United States equity trading volume, which is double the share from a decade ago. 62% of American adults own stock in 2025, the highest level since before the 2008 financial crisis. Two-thirds of new brokerage accounts are opened by investors under the age of 45. Mobile apps now execute 75% of all retail stock trades globally. Thanks to zero-commission trading, fractional shares, and social media, the barriers to entry have been permanently lowered. The retail investor is no longer a marginal participant. In specific names and volatile sessions, retail flow can be the dominant force. The GameStop episode in January 2021 showcased retail power at scale. Short interest in the stock reached 122.97% of its float, meaning more shares were sold short than actually existed in the tradable supply. A coordinated buying wave from retail investors, organized on the Reddit forum Wall Street Bets, forced short sellers to cover their positions. The stock peaked at $483 on January 28, a roughly 190-fold increase from its pandemic low of $2.57. While the SEC later reported that hedge funds were not broadly affected, some funds closed short positions at massive losses, while others saw gains. Market makers are the invisible infrastructure of the stock market. They are registered broker-dealers that stand ready to buy or sell securities continuously, posting bid and ask prices to create liquidity. Without them, executing a 1,000-share order in a thinly traded stock could move the price by several percent. In modern markets, a handful of electronic market makers dominate the space. They earn the spread between the bid and ask prices, often just fractions of a penny per share, and profit from volume at scale. Their role is not directional speculation. It is intermediation. They absorb temporary imbalances, hold inventory for mere milliseconds, and hedge their exposure through derivatives. Two firms handle a disproportionate share of retail order flow. Citadel Securities' automated platform trades more than 20% of total United States equity volume and executes approximately 35% of all retail volume. The firm generated a record $12.2 billion in trading revenue in 2025. Virtu Financial, a public company, provides liquidity in over 25,000 securities across more than 235 venues in 36 countries maintaining a 58% adjusted EBITDA margin in 2024. Other significant players include Jadon Street, Optiver, Susquehanna International Group, Hudson River Trading, 2 Sigma DRW, and IMC. When you place a market order through a retail broker, it is typically not sent directly to the New York Stock Exchange or NASDAQ. Instead, it is sold to a wholesale market maker like Citadel Securities or Virtue, which executes it internally. The broker receives a payment for routing this order, known as payment for order flow. In just 9 months from April to December 2024, Citadel Securities paid $943 million for retail equity and options order flow. In exchange, the market maker captures the spread and gains visibility into retail order flow, which is historically considered to be less informed than the institutional flow we discussed earlier. High-frequency trading firms use autonomous algorithms to trade in microseconds, seeking to profit from tiny price discrepancies. Their strategies include market making, statistical arbitrage, momentum ignition, and latency arbitrage. To minimize signal travel time, these firms co-locate their servers inside exchange data centers. 54% of them use these services. 47% even deploy AI-based predictive algorithms. They do not hold overnight positions, as their inventory turns over thousands of times per day. Their collective activity narrows bid-ask spreads and improves price discovery, but it can also amplify volatility during market stress. By the numbers, high-frequency trading accounts for approximately 55% of trading volume in United States equity markets. In North America, 73% of equity trades are executed through algorithmic systems, with nearly half executed within microseconds. The global market for this technology was valued at $10.36 billion in 2024 and is projected to reach $16.03 billion by 2030. The market-making segment accounts for 72.3% of this revenue. Despite this dominance, the number of dedicated firms has actually shrunk since the early 2010s as the barriers to speed infrastructure have risen, leaving a smaller group of well-capitalized incumbents. Not all trading happens on public exchanges like the New York Stock Exchange or NASDAQ. Alternative trading systems, or dark pools, allow institutions to trade large blocks without displaying their orders publicly. In 2024, off-exchange volume averaged 44% of all United States equity volume. Pure dark pool volume accounts for roughly 15 to 18%, with the rest attributed to wholesale market maker internalization. This is a dramatic shift from 2005, when off-exchange trading was only 25%. Large-cap stocks like Apple, Microsoft, and Amazon consistently see 40 to 50% of their volume trade off-exchange away from the public eye. The flash crash of 2010 remains the clearest case study of participant interaction gone wrong. At 2:32 in the afternoon, a mutual fund firm initiated an algorithmic sell program of 75,000 E-mini S&P 500 contracts. The algorithm targeted 9% of the prior minute's volume with no price or time constraints. As liquidity thinned, high-frequency traders withdrew from the market, causing the Dow to drop 600 additional points in 5 minutes. A subsequent investigation found that a lone trader in London, using spoofing algorithms, had exacerbated the imbalances. New regulations were eventually introduced by 2015 to ban spoofing, layering, and front-running. The GameStop episode of January 2021 was a different kind of collision, retail coordination against concentrated institutional short positions. With short interest exceeding 100% of the float, the market was a powder keg. As retail buying surged, short sellers faced margin calls and were forced to buy shares to cover, driving prices higher and triggering more calls. The SEC noted that some hedge funds actually purchased the stock as the price rose, adding more pressure. Brokerages eventually restricted buying on January 28, not because of a conspiracy, but because clearinghouse deposit requirements had become untenable. It was a perfect storm of retail sentiment and institutional fragility. Ultimately, prices move because of imbalance, not ideology. A pension fund rebalancing $2 billion into bonds creates persistent selling pressure. A hedge fund adding leverage to a momentum trade accelerates a trend. A market maker widening its spread removes liquidity during volatility, while a retail buying surge can trigger a feedback loop in shorted stocks. No single participant controls the market. Institutions set the trend, Market makers set the spread, high-frequency firms set the speed, and retail sets the sentiment at the margin. Understanding which participant is active in a given moment will explain more about price action than any chart pattern ever could. Here are your strategic takeaways. First, your time horizon is your only durable edge. Institutions face quarterly pressure, hedge funds face redemption windows, and high-frequency firms hold for microseconds. You can hold for years. Second, remember that the price you see is a composite of conflicting objectives, not an objective truth. Third, be aware that off-exchange trading accounts for nearly half of all volume, meaning the public order book is incomplete. Fourth, in heavily shorted stocks, the combination of retail buying and forced institutional covering creates explosive action. Finally, the market structure that enables narrow spreads also enables flash crashes. Always remember that liquidity can vanish in seconds. Now that you understand who is on the other side of your trades, the next question is, who is your most dangerous opponent? It is not BlackRock, and it is not Citadel Securities. It is you. In Episode 7, we will cover the 10 most dangerous cognitive biases for beginner investors, from anchoring and loss aversion to the fear of missing out. We will explain why understanding these mental traps before you invest is significantly more important than picking any single stock. I will see you in the next episode to master your own psychology.